So tonight we'll be talking about our topic for tonight is order block and FVG or imbalance. So that's our topic for tonight. So I will I will try and do justice to the topic. So depending when the Bella will take over. So but without taking some of our time, like if you have your pen or your Bible, if you have your Bible and your book, please try and write something down. And if you do not have, just try and get a Bible and maybe a jotter that use you for our classes. So, but before I proceed, I'll first have to say that when you say about order block, because the topic says you have to talk about the order block and the FVG. Some people call the FVG imbalance as well. Some people call it inefficiency, all those stuff. They are just parameters. So you don't have to get carried away. Just understand the concept, because in trading there are different types of terms, different types of terminologies whereby what you know is what another person also know, but they'll just use word to change it for you. So that is it. But before I proceed now, when we say talk about like order block, so that we can have, I'm coming. Can you see my screen, Dagala? Hello?
Not yet.
Can you hear me?
Not yet. Yeah. You are sharing the screen now, but it's not yet. It's not yet showing anything.
No, I'm seeing the green something.
Yeah, I can
Yeah.
see your screen now. I can see your screen now.
Can you see the thing?
Yeah, I can see the screen now.
Okay. Okay, thank you. Let me just proceed. So because of time has gone already. So now let us talk about, if you look at this slide, this number 34. This slide, I'll just be using this slide alone to explain for now before I move to the main chart. So if you can slide now, you can see that like when we talk about gaps, you also know what gap like distance between two something, like 2 points, like that's what we call distance, like is or gap. So now, but they call it fair value gap. That's just a parameters. They also call it imbalance or inefficiency. Just note that. Then when we talk about order blocks, is that a fair value gap is an imbalance in price action, which is telling you that when we talk about FVG, it is an imbalance in price action. When we talk about price action, like maybe how is the price of the market going? Like try and open chat so I can maybe I will. When they say that something is imbalanced, it means that things are not equal. If you have maybe a scale of A and a scale of B, let's say you place maybe like a 50 gram of something on scale A, you now place a 1,000 gram of something on scale B. You know that one will surely weigh past one. That's like imbalance. But in trading, it's not about weighing, but it's like telling you that it's inefficient. You understand? Like what happens in that scenario is not something that is like that is equal. It means that they are not evenly distributed. Like it is like there is a power over another power. That's what makes it imbalanced. It says that a fair value gap is an imbalance in price action, which means that the buyers and the seller, they are not what they are not in the same level at that moment. Is it that the buyers are very, very much more higher than the volume of the sellers at that moment? Or if it's a downtrend, the sellers are very, very much higher than the buyers. That's why we say that it's imbalance, because they don't have mutual agreements. In other words, a fair value gap is an imbalance in price action where there is a visible gap between candles, usually caused by aggressive buying or selling with little to no retracement, which is telling us that, let me try and find, I don't want to jump to chart. I want to make it I want to buy the theoretical part first before I go to the chart. So that I can write something down. Now, they say that this imbalance in price action, we all know price action. So now, it's either when it's an uptrend, it's telling you that there is aggressive buying in price in the price of the particular assets at that moment. And if it is in a downtrend, it's telling that there is an aggressive sell in the market at that moment with little to no retracement. At that moment, just flying like you can look at Bitcoin this afternoon, or yes, towards afternoon that evening. You see how Bitcoin is. Let me just show you. You see how Bitcoin is flying.
Your audio is a little bit breaking. Can you hear me, Leader Abdullah? Your audio is a little bit breaking.
Like, let me show you some stuff here. So, like, see here, now. Hello, now, can you hear me? Like,
your network is bad. Your network is bad.
Can you hear me now?
Yes, I can hear you now. Oh. Okay, no problem. I'll take it from here.
Can you hear me now?
Yeah, we can hear you. Is your network okay now? Yeah, I can hear you clearly. All right, Leader Abdullah, I'll just continue from here prior to the time you fix your
Now, I'm not outside. I'm outside. Looking now. Outside.
Okay, is it okay now?
Can I proceed?
Yeah, you can proceed. You can proceed.
No.
All right, you can proceed. I think his network is not good. Okay, can everybody hear me clearly and see my screen? Please, if you can see my screen and hear me clearly, just type 1 in the chat box so I know that you can hear me and see my screen.
You're
So,
very loud, leader.
okay. So, like you can see, Leader Abdullah was trying to tell us fair value gap or imbalance, right? Which we call IMB, abbreviately from most of the terminologies we use in trading. In generally, depending on the strategy you are either trading. So in price action or in SMC, we call this fair value gap or imbalance. So these are places in price in which there are imbalance in price, like where there are inefficiencies in price. So whether it's either in an uptrend or in a downtrend, in which when there is imbalance, when you see imbalance in an uptrend, means there is high volatility in that trade. So which means the buyers are really aggressive and there's a lot of manipulation or lot of liquidity in that trade, which is pushing that price high. So leaving little to no retracement in that trade. So how do you then spot this imbalance? It's very obvious. from one of the classes we did the last time. I told you when there are institutions joining the market, right? The big players in the market, when they are joining in, like the hedge funds and all of it, when there's a lot of smart money joining the markets. So when we say smart money, what do we refer to as smart money? We mean huge liquidity, huge money. In the banks, the big banks, the whales in the market, when they are pumping in money in a particular asset, you see a lot of volatility, and they tend to manipulate price. So by so doing, they grabbing liquidity. So where we have our liquidity grabs, we talk briefly about liquidity grabs and all of it. But then just know that on your chart, it's very visible and will show you how you can spot these moves in a day-to-day trade or chart. So I'll open my chart right here from. So Leader Abdullah also was talking about some scenario today, this afternoon. I was not actually on my chart, but then there was a lot of push on Bitcoin today, which probably caused a lot of you see, price actually came into. So if you can see from here, the last time I told you about some, if you want to spot your institutional candle, there's a way you can spot your institutional candle. So there will be 3 Marabusu candles that will be forming. So you will have 3 Marabusu. What do we call? We did candlestick and candlestick anatomy of candlestick, and we talked about different type of candlesticks. And one of those candlesticks we talked about was Marabusu candle, right? We say a Marabusu candle is a big candle that has body or without the body at all, or has a or tiny body. So you have 3 types of Marabusu candle. One without the wick at all, just has a huge body. It can be either a bullish candle or a bearish candle. So this is a Marabusu candle. So let's write it out. I pick my test tool, Marabusu candle. So you have your Marabusu candle. There are 3 types of them. And when you have the very one that is very bullish, the most bullish out of the Marabusu candle, right, is the one without the body. And you also have the one with the body and the wick, but a very tiny wick, okay? You have the one with the wick, but the very tiny wick, okay? That's a tiny wick. Don't mind my drawing, but get the concept of what we are trying to say. You have a wick. Don't just mind my drawing. I'm coming. Okay, I'll just put this one. My drawing is not that perfect, but don't mind it. Just try to understand what the concept. So you have another candlestick with a small body, with a large body and a small wick, okay? And you have at times a Marabusu candle that will just have only the top wick without the upper wick, okay? And it can be either a bullish candle or a bearish candle, okay? So those are the 3 types of Marabusu candles that you will see. They have huge body and tiny wicks, okay? So what we are trying to achieve with this Marabusu candle is that when you want to spot your fair value gap or your imbalance, what you are looking for is when smart money joins the market, when the institutions, right? When the institution, the hedge funds and all of it, when they join the market, they tend to push the market really high, okay? So by so doing, they are living in inefficiency in price, so they are living in gaps, okay? The normal way we say gap, the FVG, so they leave fair value gaps, okay, in the market, which are actually which is the second topic that we are talking about this evening. So those gaps that they left in this market are leaving most order unplaced, okay? So now we'll get to the second topic of the night, which is order blocks. So there are orders mostly left unfulfilled, which price will later come back to come and tap in. So now, when you have the three Marabusu candle, right? So now, we talked about the Marabusu candle, and you can see them like you have huge body. For you to be able to know that you are in an inefficient area in your chart, and there is for you to confirm that it's a real fair value gap or an imbalance, you have to be able to spot your three Marabusu candles, which are following each other consecutively, and there is a gap between them. There's a gap between the first and the third candle, okay? So it can be from the body or from the wick of the first and the third candle. So now, let me draw three Marabusu candles to show you what I mean. So you already know that these three candles here that you're looking, those are the three examples of your Marabusu candles. Those are the three examples of the Marabusu candles. So now, if you want to spot your FVG, someone is raising their hands.
Leader, Leader, please, this Marabusu candle, can you show us on a live chat?
Yeah, of course, I will do that, definitely. So now, these are your three Marabusu candle, but then let me show you what's going to practically happen. So now you have one, and then you have two. So they are following each other just like this, just this way. And there will be another candle up here. And within it, you have this gap. Within it, you have this gap. So you can have the candlestick just like this. So either of these candlestick could be a bearish candle or a bullish candle. It doesn't matter, okay? What is the most important thing is that you have this gap in within. This gap within it. Okay? Between the third and the first candle, there will be a gap within it. There you will spot that there are institutions actually joining the market. So let's spot that on our Bitcoin chart here. So look here right now. You can see what I was talking about. Look at the first candle that popped out. So look at this market. If I zoom out, right? You can see market was a bit bullish. Bitcoin came to around 107, right? And then at a point, look at, we had these three push. And if I should pick my trend line, right? This is the first candle. And you can see, what do we say? We said a Marabusu candle can be a very bullish one, would be the one without a wick, okay? look at this candle that I'm showing you. Can everybody see what I'm showing you? You can see if you check this candlestick right here, there's no wick at all, and it's very bullish. Okay, this one, you could see that institutions are already joining the market. They pushed this market, and it printed 3 Marabout candles, 3 consecutive Marabout candles, and voila, you can see the first, and this is the third candle. Even the third one also is a very strong Marabout candle without a wick. This is having no wick at all. And the one beneath it is having a smaller wick, but you can't even see it. It's not visible, okay? So now, if I should pick my trend line and I draw from the body of this very candle, and I draw from here also, you can see that there is a fair value gap around here. Okay, so market made a push from this area here, from this down here. See, it's in an uptrend. You can see. Okay, see what market did here, and this is a clear fair value gap. This is a fair value gap, FVG. Okay, this is a fair value gap. So now you would say if then you are able to spot where your institutional candle is. Your institutional candle, right? The institutional candle right now is this one. Okay, now is this fair value gap here, this inefficiency in price. Okay, now the next thing for us to spot would be our order block, where we know that. So let's go back to the slide and read what is the meaning of order block. Okay, so now you are here, you say an order block is the last bullish or bearish candle before a strong move in the opposite direction. Read it clearly. An order block, an OB, okay? An order block is the last bullish or a bearish candle before a strong move in the opposite direction. So we know that if it's in a bullish if it's in a bullish direction, okay? If it's in a bullish direction, is the last bearish candle. Okay, later you can go ahead. You are still raising your hand.
Okay, what I'm saying, can you go back to where we are before?
Yeah,
When this Marabout candle show, is it telling us that we can enter for long? Is it a source of indicator to enter a trade?
Yeah, it's a form of it's one of the confluences that we have to see in the market to know that there is institutions joining the market, there is smart money joining the market. Okay, one of those confluences that you have to see in the market that is telling you, okay, if this trend it's in an uptrend, it's an indication for you to go long. Okay, but one of those confluences that you have to see. So first you spot your FVG, which is your fair value gap, or your imbalance. In this case, it's FVG because the gap between these two candles is very small, it's tiny. But if the gap was up to like this, like for example, this gap here, so from here to here, so if it was big, if this candle between here, the gap was big up to this one, it's imbalance, okay? But now it's telling this trend is strong, but not that strong to up to the one that will be an imbalance. If it's fair value gap, there's a lot of trend, okay? But it's not that strong compared to the imbalance one, okay?
Because I see that after the institutional candle, the trade started coming down again.
Yeah, they pushed it up here because we have another block. So now let me go back to what I was saying, okay? Because there is still an order, right, that is left for feed yet, okay? That's why there is still a pullback here, okay? The institution, they split their orders. They split their orders, okay? So the direction that the market wants to go is an uptrend. But firstly, they first take out the liquidity up here. They take out liquidity and then later come back to pick order before they now push back strongly to the upside. Okay, so now let's go back to our to the slide. Now you see another block is the last bullish or bearish candle before a strong move in the opposite direction. In an uptrend direction is the last bearish candle, okay, before the up move. So which, if from before the 3 Marabusu candle form, which is the last candle? Is this candle here, this very candle, okay? This is the last bearish candle here, which is this one. So depending on how the candle forms, you want to draw it from the body, but since this candle is very small, you will draw from the wick to the body, okay? And you map it out like this. You can see there's a push back, but this would have been a missed entry because it didn't tap into it, okay? But it's a missed entry. They actually pushed back the market, but it's a missed entry, okay? But this is another block. This is a valid order block because this is the last bearish candle market printed before the up move, okay? So you first figure out your fair value gap, then the last sell candle before the up move is this. So this is your order block here, okay? Your other block is this, and this is your LVG. Do everybody understand this concept? Is there any question? Do everybody understand this?
You said the other block is the last bearish or bullish candle before the uptrend
In
or the downtrend. So what is the implication? What does the implication does it have in picking trades?
I didn't get the question right.
The other blocks, you defined it as the last candle before the bearish or bullish movement, right?
Okay.
Or the bearish trend. So I'm asking, what is the implication of that other block?
The other block is telling you that this, when they say other block, right? When you even hear the word, it said order, right? So if you place an order in an exchange, it means you want to buy, right? So if I say an order block means that there's a huge buying orders left in this area, which means there's a lot of buy in this area. So that price, right, is the fair price for that asset. But market is just the institutions, right? The smart money, they are just faking this buy to the upside. But the main place where they want to buy from before they push the price upward is this order block here. So which means if you place your order here, right, from when the market start pushing upside, you can actually buy at a discounted price before the price will then come back to that your order block to go to the upside. I don't know if you get my, do you understand? Was I able to answer your question, Leader George?
Yes.
So another block is actually a spot in which a lot of institutional or
let me see if it's what. Can you hear me?
Yeah.
Can you hear me?
I can hear you. Go ahead, Leader George. I can hear you. Yeah, go ahead.
Okay, that means after once the other block, what I'm saying here, because this the line you drew now, is this saying that okay, after the institutional candles that one can short the trade because of the other block that did not complete the order, that the coin the market will still come back to that order to fulfill it, right?
Let me break it down.
That's what I'm getting for me too.
Yeah, so let me break it down. So for example, imagine there is smart money, right? The bank. Okay, me and you, we are retail traders. Okay, but then there's a bank somewhere that has $100 billion that wants to trade. Okay, then he splits this, but now they have a lot of money. They have this so much money, right? That you know that if they place with this $100 billion, it's going to push the market very high. Okay, and there is a lot of sell orders above. Okay, so what they do is they split. They can take out of this $100 billion they are having, they take $20 billion, right? To first push this trade from this price here. So for example, from where they started to push this price, from this 107, they placed $20 billion first to push this price up to this extent, to take out, to buy all the orders that the sellers are having from here or to this extent. But where they are intending to go is up, okay? But then they just did all of this, right? But the main buy they want to buy right here is around here. The main buy they want to buy is here, this other block here. And then they have another extra $80 billion waiting here to actually buy low, okay? So, but then they actually first fake this buy to take out the premature sellers out from this area. Okay, this is what the institutions they do. They just use this $20 billion to take out these people from here. They take their stop loss, they buy everything off. Okay, and then they take another $20 billion again from their 100 billion. They push the market back to this side again. Okay, they push it from here. They now take another $20 billion. They push the market back down to this place. Okay. Now they have, don't forget, from the 100 billion, they spend 20 now. They spend 40 now. Okay. But then where they are actually intending to push the market to might be even way higher. Okay. So it might be even be way higher from what you are seeing here. So they might be intending to say they want to take this trade to all the way to 120. Okay, so now they intend to buy low. So now they have a lot of order that is waiting here. Okay, so they use this 20 billion to push it up here. They use the other 20 billion now. When they clear all this liquidity out here, they push the price back to this other block. You know that from this other block here, when they start to buy now, when they want to push this price now, it will go higher. Okay, they lost this money here. This $40 billion, they lost it, right? They bought all these positions, and now they sell now. You now that will now join now, the retail trader that will now join above from here now will be buying from the retail, will be buying now from the banks. I don't know if you get my explanation. So they use this money that they pump into the market to manipulate price, right? To actually accumulate all those buys now, to them buy that market now back to the where they believe that the price is actually cheap for them. Okay, when they take the buyers and the sellers, the premature ones, they take them out. Now they will now push this market back up to their own precise place they want to take profit, which might be here. Okay, so now you now imagine that you as a smart money trader now, knowing that this is where their order is, you place your own same order here, you join them, then you also make profit. Knowing that, okay, this market did this, it's going to break this structure. Okay, this is your order block. This is where this market broke the structure. And then you draw your structure, it meets all of it. And then it push you and you can make 1:3, 1:20, whatever. So do you understand? Were you able to understand the concept?
Yes.
So that is the essence of an order block. So there are orders that are not fulfilled. So if you even go back to the slide, you will see. So an order block is a last bullish or a bearish candle before a strong move in the opposite direction. So if you go further, representing institutional buying or selling zones, you see, representing institutional buying or selling zones. Price often returns to this area before continuing the trend. Used for entries, stop loss placement, and market structure validation. You see, so this order block are buying zones and selling zones for institutions where prices are being placed. Okay, so these are like limit order that the institution actually left untapped. So they push markets to their desired direction by manipulating price. So is there any question to identify market manipulation by big players? So before we even go further to break this down about the manipulation, so is there any question as to regards to what we've said up to this instance? So if you have any question, please type in the chat box if you have any question about fair value gaps, imbalance, or OB, which is your order block. Do anybody has any question? If you have any question, you can type or you can unmute and ask the question. So as in regards to the topic for tonight, we breaking it down. I even went further to also explain a little bit about manipulation. Okay. So is there any question, please? If you understand what we talked about this evening, you can type 2 in the chat box. Please type 2 in the chat box if you understand what we said about. We still have like 10 minutes. Please, if you have any question or you are just joining the class or you don't understand, if you don't understand, type 3. If you understand what we've said, type 2. If you have any question, you can raise your hand or unmute, please. You see, Leader George, he didn't understand. He asked the question and I explained it. I break it down for him. So don't be shy, please. We are here to learn. Abdullah was able to join. I think his network was bad. Okay, I think someone 3. Chibuike Franklin. Please, can you specify where you don't understand, please? Is it the FVG you don't understand? If the order block you don't understand, because the topic for today is the fair value gap and the order block. So which part of the topic you don't understand? Is everything or a specific place you don't understand? Chibuike Franklin. You can also unmute. Please be specific so that I can quickly answer your question, please. All right, do any other boy has a question? So briefly, since this person is not responding, I'll just briefly go through what we've talked about. Order block. Okay, order block. So let me go back to the slide. So I believe you can see my screen, right? So an order block is the last bullish or a bearish candle before a strong move in the opposite direction. So when it's so let me open my charts. So we have a trend, right? Which is bullish. So let's say we have a bullish trend. We have a bullish trend like this. So you will agree with me that this is a bullish trend. I'm trying to explain the other block to you, right? So I'm explaining another block to you right now. So let me break that down. We have an uptrend, and the definition of an uptrend, right? The definition of an uptrend. If you are following the classes, you know that we broke down this to you the last time. So now we have an uptrend, okay? So I will even use my trend line to identify this as an uptrend because why? Why do I say this is an uptrend? This is an uptrend because it meets our criteria. So for you to have an uptrend, market has to create higher highs and higher lows. So market has to create higher highs. So market has to create a high, higher high, and higher lows. So it has to create a high, right? It has to create a low, sorry. A low from here, this is the low, this is the high, and this is the higher low, and this is the higher high, and this is a higher low, and so on and so forth. Firstly, for we to have a valid uptrend, right? Market has to create a high, a low, it has to create a low. We have a low, if we have a high, you have a higher high and higher low, and so on and so forth. And then it has to also break structure to the upside. So now we should have BOS. BOS is when the recent high is broken to create a new high. So let me be snappy with this BOS. So if we have, let's assume this is our low. This is our low. And then we have a high. We have a high. And then we have a higher low. And then we have a higher high. And then we have a higher low. Okay. And then for we to have an uptrend, market has to break structure to the upper side. Okay. Now, which means this high here has to be broken to create a new high for we to have a structure, a valid structure. For we to have a structure to say this is an uptrend, market has to break structure to the upside. So what is the structure? The high is that the recent high has to be broken to create a new high. So now it did that already, and we believe that this is an uptrend. Okay. So now let's talk about the other block. Okay. So this is a BOS for better understanding. Okay. Up till now, I believe you understand because we talked about this in our previous classes. You can also go and watch. So now, for you to now have your order block, since you know that market is breaking structure to the upside and is giving you already an uptrend. So now we talked about also the Marabusu candle this evening, and we said for the next thing we have to spot now is to spot institutional candle. So the institutional candle, for you to get an institutional candle, you have to have a very bullish candle. And a Marabusu candle is a very bullish candle that has a big body. At times he has a wick, at times he doesn't, okay? But then, if you are able to then spot your, so which will be this that we already spot in on here. So we spotted this, which is our Marabusu candle, okay? So now, we said in Marabusu candle, we have a huge body, okay, without a wick at times. And for you to spot your institutional candle, for we to be able to have our gap, we'll have three consecutive Marabosu candle with a gap between the third and the first candle. Okay. So the first candle is this one that pushed this market upside, and it's a very huge candle, okay, causing inefficiency in the market, causing a gap, okay, the FVG, okay. So now the first and the third candle, the gap between it is your FVG, which is the gap between it. So there's an inefficiency in this market because why? The huge money joined the market, the banks, okay, the smart money joined, so it's causing an inefficiency, which is leaving orders that hasn't been filled, which is our order block. So we said, what is an order block? So from the definition here, it said an order block is the last bullish or a bearish candle before a strong move in the opposite direction. In an uptrend, the last bearish candle, and a bearish candle is it's in a red color, right? So now, since we know that the market is in an uptrend, what should we be looking for after our up move, the last up move that created? We know that this is the up move that the market created, right? The one institutions down the market, we already defined it. But the last candle that the market created, that is the bearish one in an uptrend. In a downtrend, it will be a bearish, it will be a bullish candle, which will be this. Okay. But in a bullish scenario, it will be the last bearish candle, which is this. So you want to spot the last bearish candle. And before the market move, so if you were looking for in the bearish scenario, this would be our guy here. You see, before the bearish move. Okay. And there's a gap here. And if I should draw my trend line, you can see there's a gap here. Okay. So the last candle, the last bearish candle in an uptrend, the last bullish candle in a downtrend. That is your order block. Do you understand now? So which means from the example I was giving to you, so from the example I was giving to you, you would have your order block right here before the up move. So it will be somewhere around here, which is the exact same thing I'm showing you in a live trend. Okay. So your last bearish candle will be around here because why? The price move really high from here. And then the last bearish candle around here from in an uptrend. So in a downtrend, it will be your last bullish candle. So do you understand? What was the name of the person that asked that question? I think it was Chibuke, yeah. I said yes, okay. So is there any other question? I hope everybody understood. Because we're actually up on the time right now. So if there is no other question, we'll call it a day. So is there any other question, please? If not, we'll be wrapping up. You already know we have our classes 8:30 p.m. every day up to Saturday. And the same time, don't miss any of the classes. And whenever you are coming to the classes, I always recommend that you come with your notes, always take notes, always ask questions. And in this business, you know, there is no enough knowledge. The more knowledge you have, the more money you can make and the more edge you can have in this business. So I'm really I'll say thank you to everybody that attended this class this evening. Always come to the classes. Don't say this class is better than the other class and all of it, but every class that we have from Monday to Saturday are all important for your growth. So don't miss any of it. See you in our class tomorrow. All right. Do you have any other leaders in the house that want to add anything? If not, we'll call it a day. So in the absence of nothing to add or no question, I'll say good night, everybody. See you tomorrow.